All right, the personal consumption expenditure report came out today a little bit hotter than expected. We're going to take a look and see how that's affecting our home loan interest rates. But we're going to take a minute here and look into the future because we want to answer that question of when do we think home loan interest rates are going to come down? And I'm going to show you basically how the Fed looks at things and what we expect to happen in the future and what needs to happen in the future for home loan interest rates to get back down to where we're in a little bit more comfortable situation. So let's take a look today at the main headline of the day, which is based on this PCE. As you can see here, the Fed's preferred gauge shows inflation accelerated even more than expected in August. Core inflation rose to 4.9%, and the monthly number, and we're going to get into this in just a minute, is at 0.6. Okay, so we need to understand that these numbers really matter to us in the real estate community, and let me show you why. So if I jump over here, this is from the Bureau of Economic Analysis. This is showing you the monthly numbers. It's a chart of all the monthly numbers over the past, what is this, almost 2 years, 18 months, something like that. So here we go. There's your 0.6 that we just saw on, again, core numbers, core inflation, 0.6 for August, right? There's your 0.6 for August. Now, if you were to add 12 months together, that's going to give you your annual number, which is at 4.9. So that's where they're coming up with these numbers. Now, again, we're looking at core personal consumption expenditure. The core reading is the personal consumption expenditure excluding food and energy. Now, I don't really like that. I don't like that they exclude food and energy, and that's the number that they're looking at. The Federal Reserve basically says, hey, gas is so volatile. I mean, if a pipeline breaks or if the federal government opens up the strategic reserves, that dramatically changes gas prices from $5 to $3. We've seen that happen even in the last 6 months. So they kind of kick that number out. Now, again, why would you not include gas and food? I mean, like, those are real things, right? I mean, I know that you and I, gas and food are pretty important, but for whatever reason, the Federal Reserve likes to look at the core number. Now, the Federal Reserve is really who we're worried about, right? Because they're the ones who are going to either increase or reduce the federal funds rate, and they are going to be making the most dramatic impact on basically the economy here. So we are going to pay attention to the number that they pay attention to. All right. So let's jump over to a little chart that I've made here. Still feeling a little bit sick here from this week, so I apologize for my voice. But all right, so this is where we're going to be able to predict the future of what we think is going to happen and how we're going to get home loan interest rates down in the coming months. All right. So first of all, let's understand what just occurred. This is previous to today. This is yesterday. So yesterday, the annual PCE, the core PCE was 4.7. And that's because we were using the August of 2021 figure, which was 0.4. Today, we get to kick out the August of 2021 and replace it with August of 2022. Add all of these numbers together, you get 4.9. So obviously 0.6 is more than 0.4 by an amount of 0.2, which is why you went from 4.7 to 4.9. You follow me? All right. So once you understand how this works, you get to start kind of predicting the future and trying to be able to say, well, when do we think things are going to change? All right. So what you need to understand is each month we get to kick out the month from the previous year. So we get to kick out September, then we get to kick out October and November and replace it with the monthly number of this year, 2022. All right. So what you need to think about is, okay, well, what number are we kicking out? Well, for instance, next month for September, we're kicking out 0.2. That's not a very high number. That's a low number. So if you were to say, Brent, do you think that our year over year inflation is going to be higher when the September number comes out or lower? I'm going to say it's going to be higher because we're kicking out such a low number, right? So if we're at 0.6 now, let's say that we get a 0.4 reading, next month, even if inflation comes down a little bit to 0.4, that's still going to make our annual number higher, 0.51 versus 0.49, because we replaced a 0.2 with a 0.4. So the aggregate total is more. So if we're going to be kicking out the next few months, these are higher numbers. A 4, a 5, a 5, 5, 4. These are a little bit higher numbers and should be easier for us to replace with lower numbers. Now, why do I think that? Because do you think that the overall economy is slowing? So you have to ask yourself that question. I do. All right. I look around and I see people starting to feel the effects of things being too expensive, of inflation being out there. People are starting to slow down their purchases. Then the Fed comes in and pumps up the cost of money by increasing the federal funds rate, which increases the prime rate. Increasing the prime rate increases your minimum payment on your credit cards and even the interest on your credit cards. It increases your home equity lines of credit. Those get more expensive. I was at Bank of America yesterday and I saw a sign that said that they were advertising their auto loans for a new car at, I think it was 4.6%. 4.6%. I mean, I'm like, wait a minute. Don't you remember when you could buy a new car and the interest rate was like 1.9 or even 0.0? So obviously the cost of buying things has come up. Gas is more expensive, food is more expensive, and people are feeling that. So people stop buying. They slow down their spending. Okay. And that leaves inventory out on the shelves. Eventually, there's inventory. Remember when there was no inventory? I mean, you couldn't buy toilet paper? Well, eventually, you will notice there's more inventory because people are pulling back on their spending. That means, number one, that inflation will slow. Okay, so you won't have prices going up as fast. And then eventually, you may even be able to see prices coming down, okay, which is deflation. But right now, what we want to do is just stop inflation, right? Because the Federal Reserve wants to see, they want inflation. They want core personal consumption expenditure to be at 2.0. They want it to be at 2%. That is their target. And that is what they are attacking. And they're going to do everything they can to get there. Right now, we're at 4.9. We have a long way to go. So how are we going to get there? Well, if we believe that the economy is slowing, then these numbers, these inflation on a monthly basis, will start getting smaller. Okay. So for instance, if August was 0.6 and we said, let's just imagine that September comes in at 0.4, a little bit slower. And then for the month of October, let's say that comes in at 0.3. Okay. I put a 0.3 in there. That would mean that the aggregate number went from 0.51 to 0.5 because we replaced a 0.4 with a 0.3, right? So from 5.1 to 5.0, I should say, to 5%. And then next month in November comes down a little bit lower to 0.2. And now this November, this 0.2, we got to kick out a 0.5. So that's a big difference. So now the year over year number is 4.7. And over and over and over, as long as the numbers that we are replacing, we're replacing them with numbers lower than the number we're kicking out, then the year over year inflation numbers will come down. So the good thing is that we're going to be replacing a lot of rather high numbers. Now, you may not know that, but these are high numbers for monthly inflation numbers, okay? So as the economy slows, these numbers are going to be replaced with lower numbers. I mean, for instance, what if in December we have a flat zero? Well, now the annual number is 4.2. That's a long way from 4.9. And it's a lot closer to that 2.0. And that is what we're going to see over not just, the next 4 or 5 months like you're seeing here, but over the next couple of years. So basically, the Federal Reserve has said that they expect to get core PCE to 2.0 by 2025. All right. Now, that does not mean that home loan interest rates are not going to come down until 2025. That means that home loan interest rates should subside as these numbers subside. Okay. So what we want is the monthly number for September, October, November, December to be much lower, hopefully at zero, but much lower than the number that we're kicking out. That is how this all works. Okay. So now that you understand that, let's take a look at where we are on the home loan interest rates. Now, if you want to learn a little bit more about this, I did a video talking about my expectations for the future and when home loan interest rates are going to come down on my YouTube page. So let's jump over to where we are on the Brent Bruce Daily. Now, yesterday we were at 6.625, I believe. And today, where are we? Now, overall, mortgage-backed security market is, pretty flat. We're up 9. The 10-year treasury is at 0. So while inflation came in a little bit hotter than expected by the markets, overall, the home loan interest rate world probably just already expected those numbers, and they're not really running in the other direction. However, here we are with the Brent Bruce Daily, which is, let me pull up the parameters here. so everyone can see that for compliance purposes. It looks like we're at 6.75. So why is it that we're at 6.75 when overall home loan interest rates are flat and we were at 6.625 yesterday? Well, the banks get to set their own pricing, right? So in general, the banks are saying, well, we want to put a little bit of hedge out there because we're afraid that the market might eventually react to the core personal consumption expenditure number coming a little bit higher and hotter than expected. So I think this is just a little bit of a safety play of pushing that interest rate to 6.75. I think we'll see that come down here pretty quickly. But we are at, for $612, we can get back down to the 6.625 range. So that is where we are after the personal consumption expenditure reading that came out today. It has been just an amazing week. I mean, I'm losing my voice because there's been so much that's been going on. I will continue to keep you posted. Let me know your thoughts on that explanation. And hopefully that is helpful for you to be able to talk to other people and kind of predict the future and see a little bit about what I'm looking at each day. Make sure that you like, subscribe, and share if you do appreciate this information. And I will talk to you on Monday. Have a great week. End.